Good evening. Welcome to tonight's educational webinar. I'm Jackie Knight, Corporate Training Director for STC, and I'm glad to have you join me this evening. Tonight's topic is going to cover some advanced information or insights about self-directed retirement accounts. Before we get started, I do want to go through just a few things. I want to mention that STC is a retirement plan administrator only, so we do not provide our clients with legal, tax, or investment advice. We also don't represent or sell securities or investments of any kind. We are not a registered investment advisor, and we don't represent or endorse any particular investment opportunities. And I may talk about some specific ones in this webinar for informational purposes. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. Now, tonight's webinar is going to cover some basic information about self-directed retirement accounts and then some more specific information for different types of accounts. I'm going to discuss Roth accounts and conversions of Roth monies into Roth monies. We're going to discuss non-recourse loans, why you need a non-recourse loan or may need one, UBIT and UDFI, two income taxes that can be applied potentially. And then we're going to discuss the retirement account LLC structure that STC offers each client, as well as all the services that we offer, and then I will open the floor for Q&A at the end. So first, some basic information. What is a self-directed retirement plan? And when we use that terminology, we mean that you, the retirement plan owner, may choose any allowable type of asset, anything that is permitted by law. And that would mean you can include what some consider non-traditional assets, like real estate, in your retirement account. Self-direction also means that you are going to manage the retirement plan's investments. You're going to make the decisions related to those investments. We'll talk a little bit more about what those decisions might be, but you're going to be in control of the investments that you have in a self-directed retirement plan. Now, you may wonder, why should I self-direct? What advantage is it to me? Well, one of the very maybe most important is that you can truly diversify into many different types of assets. You're not limited to what a particular custodian might permit you. Like bank custodians may only permit you to invest in stocks and bonds and mutual funds. But with a self-directed account, you can diversify into, again, any asset allowed by law. So I've mentioned real estate. You could also invest in mortgages and notes, private businesses, a wide range of different types of assets, as well as stocks, bonds, and mutual funds. It also means that, again, you're going to choose and you can control those investments and the transactions related to them. And if you're interested in real estate ownership in your retirement account, you can actually increase the buying power of the dollars in your account by using leverage. And that's that non-recourse loan I was telling you about. We're going to discuss in more detail. Before we get to that, let's just go through some different types of retirement plans. You may have heard of traditional IRAs and Roth IRAs. Pretty common. Many people have these types of plans and make contributions from their earned income each year or whenever they wish. Now, the big difference between these two types of plans, they actually have the same contribution allowances or limits each year, which we'll talk about on the next slide. But the biggest difference is whether your contribution is pre-tax or post-tax. So with a traditional IRA, like most retirement plan contributions, your contribution is pre-tax. In other words, you get to deduct the amount of your contribution for that year from your taxable income. So you won't be paying taxes on that contribution. However, when you begin taking qualified distributions from that traditional IRA, after you reach age 59 and a half or at some point, those monies will be included in your taxable income. The Roth is different. Your Roth contributions are made post-tax. So in other words, you make a contribution into a Roth account does not affect your taxable income that year. However, when you begin taking qualified distributions from a Roth account, those monies are not included in your taxable income in that year of distribution. So basically what that means is a Roth IRA does give you the potential for some tax-free earnings. You pay the taxes on your contributions, but then what those monies earn in the Roth account over time won't be taxable as long as it's taken as a qualified distribution. So a tax-free earning opportunity might be available to you with a Roth account. A SEP account is a simplified employee pension plan. I've seen some small businesses have this type of plan. It does permit employer and employee contributions. Sole proprietors could also have this type of plan because they're both the employer and the employee. They do everything. And it does permit some larger contribution limits, which I'll tell you about on the next slide. So small businesses or sole proprietors might be interested in a SEP plan. And the contributions are made from the earnings of the business, not W-2 earnings from an outside employer. And you can also have W-2 earnings make contributions into a traditional or Roth IRA and also have your business on the side and a SEP plan on that business and make contributions into your SEP plan. So something to keep in mind. A simple plan is a savings incentive match plan, also sometimes used by sole proprietors. I know a couple of partnerships that use this type of plan. Small business owners. It gives you some different nuances, which you'll want to talk about with your tax preparer, but does also allow larger contributions from that business than a traditional or a Roth IRA. Now I brought out on your screen 4 different types of plans that all say former employer. So a 401k, that's a for-profit corporate type of plan. 403b, often used by nonprofit organizations or charitable institutions. TSA is a tax-sheltered annuity. TSP is a thrift savings plan. If you participated in one of these types of plans with an employer and you no longer work there, then you can move the monies out of that former employer's plan into a plan that you qualify for. Perhaps a traditional IRA, or perhaps you've started your own business and now you set up a SEP. So if you're no longer employed, you can move those monies out into a plan that you qualify for, and if you wish, self-direct those monies. Now, I will say that if you are still employed, then you will need to go to your plan administrator for whatever type of plan you have and ask them if you are eligible to move any of the monies out of that plan into a plan that you might be able to self-direct. Sometimes documents are written that if you reach a certain age, you can move monies out. Sometimes the plan documents are written that if you brought money in from a former employer's plan, you are eligible to take that money out even while you're still employed. So you will want to talk to the plan administrator and see what their specific plan rules are. One last plan that I do want to mention is a solo 401k, sometimes called a uni 401k. It's basically a 401k for a sole proprietor, someone who is in business for themselves, by themselves. You really can have very, very limited employees. You could have a spouse who was involved in the business, but the solo 401k plan does give a sole proprietor some additional opportunities because it is a corporate type of plan. It is on a business. It does permit you to have a Roth provision for the employee portion. You can have both an employer and an employee contributions into a solo 401k. So you could make your employee portion a Roth account. It does also offer a loan provision. Sometimes small business owners, sole proprietors might need to borrow some money from their plan, and that money can be borrowed for any purpose. It doesn't have to even actually be for the business's purpose. As long as it's paid back according to the terms set up in the plan documents with interest, that money can be used for anything. So it has some nice features: solo 401k, a Roth provision, a loan provision. If you are interested in that type of plan and you currently don't have one, then you do need to open a solo 401k by year end in order to make a contribution for that year's earnings. So too late to open one for 2023, but for 2024, if you open that plan by December 31st, then you could make contributions into it for your 2024 business earnings. So some things you might want to discuss with your tax advisor about plans that you're eligible for and what you might want to consider. Now, a few more specifics about different types of plans. There is some rollover, portability, and consolidation available to you. I've talked with some people who have multiple accounts with different companies they used to work for, even people who have multiple IRA, traditional IRA accounts. So you can consolidate those monies or move them into a new plan you qualify for. So in this top example, I have traditional IRA to a SEP. So let's say you've been working, you've been perhaps contributing to a 401k plan, but you've also been contributing to a traditional IRA. You leave that employment situation, you start your own business, you set up a SEP plan for your business. You could move your monies in your traditional IRA into that SEP account and create a larger investment pool if you wished. And the reverse is true also. Let's say you've had a business, you've been contributing into a SEP plan, and perhaps you're ready to retire, and you're not going to be able to contribute to this SEP anymore because you're closing down the business. So you can move the SEP monies into a traditional IRA. Keep the money in one big pot. Now the traditional IRA is available for you to invest. So it goes both directions. Now here, I'm showing a kind of a different situation. We're moving money from an IRA, traditional IRA, or a SEP, or a simple plan to a Roth. You can do that. Now, keep in mind that IRA, SEP, and simple plans are all pre-tax contribution types of accounts. So that money has never been taxed. If you want to move that into a Roth account, remember Roth contributions are post-tax, then you would have a tax consequence. So you will need to keep that in mind if you decide you want to roll over pre-tax money into a Roth account, which is post-tax money. When you do roll over to a Roth, that income will be, those monies, excuse me, will be included in your income in that year and be taxable. Now, you can also, well, I'll talk about this a little bit later, but you can also do that in a graduated form to minimize tax consequences if that might be helpful. And with a Roth account, you can take tax-free distributions from a Roth account once you reach age 59 and a half, and that account has been in existence for 5 years or 60 months. There is a 5-year holding period to take tax-free distributions from a Roth account. Now, with a simple plan, let me just pull this down. Just a comment about simple plans. Simple plan distributions before a 2-year period, like if you take a distribution before that simple plan has been open for 2 years after beginning participation, you may also have an additional tax with a simple plan. So those would be some things that you want to discuss with your tax advisor to determine if you might be in one of those particular situations and how you might want to handle it. Now let's talk a little bit about contribution limits and RMD, which stands for Required Minimum Distributions. Now, I have updated these numbers for 2024. So for earnings in 2024, so if you are making a contribution for tax year 2023, these are not the correct numbers. You will need to check with your tax advisors. These have been updated for tax year 2024. So the contribution limits for both a traditional and a Roth IRA for 2024 earnings are $7,000. So you get a W-2 for whatever amount you earned from your employer, you could contribute $7,000 into a traditional IRA from your earnings. Now, if you are 50 years of age or older, you can add an additional $500 to that. Actually, that is incorrect. I had the wrong number there. That should be $8,000, $7,000 and $8,000. Pardon me, that went up as well. They both went up $500 for 2024. I need to correct that. So 7,000 and 8,000 for traditional and Roth if you're under 50 or over 50. Now with a SEP, the 2024 contribution, maximum contribution is $69,000. So here you see a significantly larger contribution. And that is, if you're giving yourself or you're getting a W-2 from this business, be 25% of your W-2 income up to a maximum of $69,000. Or if you are not doing a W-2, if you're doing a Schedule C as a sole proprietor on your tax form, then that would be considered self-employment income. And then you can take 20% of your self-employment income and make that contribution up to $69,000 for 2024. There's no catch-up provision with SEP plans for being over 50 or older. A simple plan, make sure I got these numbers right. Yes, I did. A simple plan, 2024 earnings, you can contribute up to $16,000, or if you're 50 years or older, $19,500. Let's talk a moment about the required minimum distribution. The age limit, there's in certain accounts, when you reach a certain age, you are required by law to take a distribution, a minimum distribution from the account. You can't leave it there indefinitely. Now, these are accounts like a traditional IRA, like a SEP, like a simple. You are required to take a minimum distribution. Now, the age limit has gone up, and it does stay the same for 2024 as it was in 2023, which is 73. So if you are 73 years or older, you will be required to take a minimum distribution from your plans that require it. Now, there is no RMD requirement for Roth accounts. So if that's the only account you've got, you're not required. So you will be getting a notice that you'll be required to take a minimum distribution if you have reached that age. And that's a calculation that's done that the IRS has figured out a calculation, and your tax preparer will be able to tell you what that is, and then you will be required to draw those monies out of the accounts, and they will be included in your taxable income. Okay, so a few more pieces of information about accounts that might be news to you. If you take an early distribution, if you take a distribution before you reach the age of 59 and a half, then it will usually be subject to an additional 10% tax as a penalty. Now, there are some exceptions. I won't go through all of those. COVID, there was a Secure Act, there's some legislation that can make some adjustments to this. So you will need to talk to your tax preparer if you need to take an early distribution. But just know that there is a possibility that there could be a penalty tax, an additional 10% tax. Early distributions must be reported to the IRS. Now, if we're talking about an early Roth distribution, only the So just something to keep in mind, if it's a Roth account and you have to take an early distribution, there will be a calculation made of what portion of that distribution is non-taxable versus taxable. I'm going to discuss just a little bit more about Roth accounts, but I will mention that if you do take a distribution and you have a taxable situation, then it will be reported to the IRS, and the tax will need to be paid from the retirement account. So that is something else to consider. Okay, so Roth accounts, let's talk about these a little bit more. There are some advantages, and the main one is that tax-free growth opportunity that I described. Also, qualified distributions. There's no required minimum distribution. You do have a 5-year holding requirement from when you first funded the account. So you do need to keep that in mind. If you take a distribution before that 5-year period, then there will be a penalty. There are some income limitations on those who can make contributions into a Roth account. And again, I'm going to direct you to your tax advisor because that changes every year. However, you could possibly make a contribution into a traditional IRA, which doesn't have those income limitations, and then convert those monies into a Roth account. So something that you can also discuss with your tax advisor. So let's talk a little bit about conversions. So this is converting pre-tax retirement money to Roth post-tax. So that means there are going to be taxes due and payable because you're taking pre-tax money, money that was never taxed, and now you're putting it into an account that requires post-tax contributions. So there will be taxes due and payable. If those taxes are paid from the converted account and you haven't reached age 59 and a half, they might be considered an early distribution and penalized with that 10% penalty. So again, something to think about and consider. If you have multiple accounts, you can actually consolidate them into a single Roth account, and you can also convert partial accounts. So let me explain why you might want to do that. Let's say you have $100,000 in a traditional IRA, and you would like to move some of that into a Roth IRA so that those earnings, future earnings on the money, will be tax-free in qualified distributions. But you don't want to convert it all in 1 year. You've got $100,000, you don't want to convert it all into a Roth account in 2024 because all of that money is going to dump into your taxable income. What you can do is you could convert $20,000, and only $20,000 would go into your taxable income for 2024, and that $20,000 now can start earning, you can start investing those monies, and you can start earning tax-free with tax-free earning potential. Then next year you do another $20,000. So you can do partial accounts. And that can be a way to avoid a huge tax consequence in a single year. So again, all these things your tax accountant should be able to assist you with. This will just help you get an immediate understanding of what you might be able to do and how that might benefit you. Let's talk a little bit about non-recourse loans. I actually like this topic quite a bit because it does afford real estate investors an opportunity in their retirement account that they might not have had otherwise. I have talked with many real estate investors who didn't know that they could use retirement funds to fund real estate investments and actually hold real estate property in their retirement account, but you can. It's actually a perfectly viable asset in a retirement account, but sometimes the investor has insufficient funds in the retirement account to pay for the property outright. So in a retirement account, you can get a non-recourse loan to help fund that real estate transaction. So what is a non-recourse loan? You may have heard of it. It's a little more like a business loan or a commercial loan. It is not a personally guaranteed loan. It simply means that the security instruments, notes, mortgages, they allow the lender no recourse against the individual account holder or the balance in your retirement account. The only recourse to the lender, if there's a default on this loan, is the property itself. That's the only source of repayment. So in other words, there's no other recourse for the lender except the property that the loan is on. So with this type of a loan, there's no income or employment verification because those things don't come into play. It's not personally guaranteed, and your retirement account doesn't have a job. It's an entity. So no income or employment verification. There are some industry standards. Of course, you will want to go out into the non-recourse loan marketplace and find terms and lenders and discover what their particular terms are. But these are just some general industry standards that will probably come into play. Required documentation. You will certainly need a loan application, purchase and sale contract. They'll want to see a statement of your IRA account or whatever type of retirement account money you're using. They'll want an appraisal of the property. If it's a rental property, they'll want to see a rent roll. Now, loan guidelines. The maximum loan to value is probably going to be 70%. You're probably going to have to put down at least 30%. So much higher than a personally guaranteed loan. The maximum term can 20 to 30 years. We have also seen adjustable rate mortgages, 3-1, 5-1, 7-1. They will also want to see an income to expense ratio of about 1.25. So let's say you are purchasing a property and you're going to rent it. So they're going to want to see incomes coming in to this property of over expenses at 1.25 ratio. And they will very likely require you to hold cash reserves or liquid reserves in your retirement account for 3 to 6 months of expenses. So let me explain why they might require those reserves. This property is going to have expenses attached to it, property taxes, real estate taxes, perhaps repairs that need to be done, things that relate to the property. That retirement account owns the property. So the retirement account is the only one that can pay those expenses. So if you have expensed, and invested all of the liquid cash in your account and property taxes come due and you're not eligible to make a contribution because you already made it for that year, then they have no way to get that money. So that's why you will be required to keep some cash reserves or liquid, very liquid reserves in your retirement account. Pardon me. Now, there are some properties that are ineligible. So first, let's talk about what's eligible. Single family residences, some condos, you would need to check that with the lender. 2 to 4-plex properties, so multi-family properties, even 5+ units. Retail, office, warehouse, all eligible. Ineligible, mobile homes, timeshares, condo hotels, some restaurants, depending, residences with 5+ acres, and farms are usually ineligible. So again, what you will want to do is go to specific lenders with the information about the property you are looking for a non-recourse loan on and see what their particular guidelines are, what their requirements are. Now, there are situations, generally retirement accounts are non-taxable. Their purpose is to benefit you when you reach retirement age. They don't incur taxes on an ongoing basis on the earnings in the account, but there are some instances where they do. UBIT is unrelated business taxable income. Now, this was designed by the IRS so that charitable organizations that don't pay taxes wouldn't have a benefit over for-profit organizations that do pay taxes if this charitable organization had some income-producing part of their business that wasn't tied to their tax-exempt status. So the IRS has now ruled that it might also, UBTI might also apply to some types of income that are generated with your IRA. So just to give you an example, let's say there is a public university that is tax exempt. However, it rents out a concert venue for rock concerts and earns money from that. Rock concerts aren't part of their charitable mission, so they might be required to pay unrelated business income tax on those revenues. So there's an example. Now the IRS has decided that even though retirement accounts are generally not taxed, if they're engaging in some kind of business that isn't related to their non-taxed function, then they will be taxed. So in most cases, the net income that your IRA generates would be tax exempt. Typically, IRA investments generate passive income, interest income, rental income, dividends, or distributions. Now, if you are purchasing and selling real estate in your retirement account, that would also be considered passive as long as the intention of the purchase was for appreciation or long-term gain or rental income. There might be some rare cases, exceptions, where the IRS might consider an investor and an active participant, and that income would be taxable. So if you bought real estate, fixed it up, rented it for 3 months, sold it for an appreciated value, and maybe did that again in a year, that likely wouldn't be considered a business inside of your IRA. But you do want to keep that in mind, that there are some things that might trigger UBTI. Real estate investments are one that can maybe bring some things into question. So let's talk about, there's a subset of UBIT, unrelated business income tax, that might apply if you have gotten a non-recourse loan and purchased a piece of real estate in your retirement account. And that is UDFI, unrelated debt financed income. So let's say you got a rental property and in your retirement account, and you did it by getting a non-recourse loan. So you now are earning rental income into your retirement account that is partially financed by debt, by a loan. So in this case, UDFI could come into play. It applies to income generated from an asset that was purchased using financing. Now, UDFI, the tax is based on the net income of the property. The first $1,000 is exempt, and only a portion of the income is taxable. The percentage of taxable income is based on the ratio of debt on the property. So let's say, for example, you financed 50% of the cost of the property, but you contributed 50% of the cost from your retirement funds. So only 50% of the income is going to be taxable because only 50% of it is debt financed. Now, when the time comes to sell the asset, if the loan has been entirely paid off for at least 12 months, then there is no tax consequence. However, if it wasn't, then a portion of the proceeds could be taxable. Let's do a little example. so that I can help you determine if it's something that you might even be interested in looking into. I've talked with some folks who say, no, I don't want to do any transaction that would result in tax consequences in my retirement account. However, sometimes they may be limiting themselves. It might be a good investment, even though there might be a tax consequence. So let's walk through an example just to help you think through this possibility. So let's say you purchased in your retirement account a rental property, and it was 50% debt finance, just like I said. Let's say it cost $200,000, you got a loan for $100,000. The other 100 came from your account. Let's say that your annual net rental income is $12,000. So net means I've already deducted all of the expenses. This is rents that came in minus expenses that went out, and you earned net rental income of $12,000. The income that would be subject to the tax is $5,000. And I calculated that this way. I said that the property is 50% debt financed. So that means only 50% of the net rental income is subject to the tax. So 50% of $12,000 is $6,000. And then I said the first $1,000 is exempt from the tax. So $6,000 minus $1,000 brings you to $5,000 that is of the income is subject to the tax. $7,000 is not, if you want to look at it that way. Oh, here's another little, this is the 2023 and the 2024 trust tax rates are the same. It's a graduated tax, it's 10 to 37%. However, the graduated levels have changed somewhat. So these are the actual 2024 calculated taxes. For 2024, this $5,000 income would require $766 in tax payments. So what that means is your net income after taxes on this particular investment would be $11,234. So now what you might want to think about is this investment generating enough after-tax income to make it a worthy investment to get a loan on? So just something to think about and help you sort of sort through how you would calculate and consider if you wanted to do something like this, go out and get a loan. Oh, one other, actually I'll say on this, that unrelated debt financed income, taxable to trust tax rate, it is reported to the IRS on Form 990T, and the tax must be paid from your retirement account because that's the entity that incurred the tax liability. But keep in mind, you have $12,000 of net income in that account to pay the $766 tax. So again, discuss this with your tax advisor and see if that might be something you'd be interested in. I do want to spend a couple of moments talking about the structure. Oh, I'm having a slide problem. Please hold on a moment while I get back to, there we go. The structure that STC uses for each of our clients. We use an LLC structure. For each of our clients' accounts, we will create an LLC structure that will become the investing entity or vehicle for your retirement account. And the reason we do that is it gives you maximum flexibility. If you are doing multiple investments, maybe you're doing multiple real estate investments, maybe one of them has leverage, maybe one of them has multiple partners. Your retirement account isn't the sole owner. Using a structure like an LLC structure gives you a lot of flexibility in doing complex transactions. And I will mention too that this is not a generic business LLC. This is a very specialized LLC that our accountants and attorneys have created that's designed to be owned by a retirement account. So its articles of incorporation and its operating agreement are specifically written to be owned by a retirement account and permit retirement account investing flexibility. Using an LLC structure does provide an additional layer of asset protection. It is truly a limited liability company, like other generic ones. It also gives you checkbook control over your retirement account funds. Now, what that means is you can move quickly on an investment and purchase it. You'll notice I have checkbook control in quotes. We do not give our clients the checkbook for their retirement accounts. If you were very knowledgeable in all the rules and regulations that related to retirement account investing, maybe you could do the checkbook and be safe, but it is possible to engage in a prohibited transaction, especially if you're not really familiar with the rules. So rather than put our clients in that position, we look over your transactions. We'll look over them to make sure that they comply with the IRS rules and regulations. They don't violate any of the prohibited transaction rules. So we can do that same day that you send us the paperwork. We'll look it over, make sure it complies, and then we can fund that transaction. So you do get the immediate response to your investment opportunity, but you have experts looking over the details of your transaction and making sure they're okay. It also simplifies asset titling. For example, if you are going to purchase a piece of real estate, you have to go to a closing. With an LLC structure, you can actually go to the closing on behalf of your retirement account because you are the investment co-manager of this LLC. With companies that don't use this structure or trust companies, you may have to submit the closing documents to the company. So send them, and if the person who looks at them is on vacation for a week, they could sit in a to-do box for a while. So that won't happen here. You can actually go to closing, sign documents on behalf of your retirement account, and then send us copies so that we can record that asset in your account. Using this structure also makes it simple, easy to pool money with other investors and co-own an investment, partnering. So let's talk about who you might partner with. Now, you can partner with yourself, with your spouse, and with family members. Normally, those parties are disqualified persons, and you cannot do a direct transaction with them because that violates some of the IRS rules. But if you partner in a particular way, if you partner with your own personal money or your spouse's retirement account or your child's investment money, if you partner with them at the inception of the purchase transaction, that is permissible. And our client services department can help you structure that transaction and do that transaction so that it does comply with the rules. You can also partner with unrelated parties, investing colleagues. You can partner with an LLC. You can partner with an investment syndication. So you have a wide range of people, entities that you can co-invest with. So you do not have to fully fund an investment with the monies in your account. You can find very good investments that don't require you to put up all the funds. Let's take a look at our retirement plan structure. You'll see on the upper left, this is your current custodian. And let's say you decide you do want to work with STC, so you complete some paperwork that directs your current custodian to transfer or roll over monies to our self-directed custodian. And while that's happening, we are setting up the LLC for your retirement plan in the state of your choice. And our operating department can talk with you about what state you might want to choose and why. And once the money has reached our custodian and the LLC setup is complete, then the ownership of the LLC moves to the custodian and the funds move to a bank account that your LLC has access to, and now you can begin investing. So in this case, you have 3 investments currently in your retirement account. Your investment number 1 is in a tax lien. So that's a different type of investment. You earn statutory interest on a tax lien. If the property owner doesn't pay the taxes, you can actually foreclose on a tax lien, and you could end up owning real estate in place of that tax lien. Your investment number 2 is gold bullion, so you've got some precious metal in here. And your investment number 3 is a foreclosed real estate property. Now you'll notice something different about investment number 3. 1 and 2 are wholly owned by your retirement account, but number 3 has 4 owners. 1 is your retirement account, 1 is your father, 1 is your daughter, and 1 is some of your personal money. Normally, these 3 investors would be disqualified from investing with your retirement plan. But as long as you see this yellow box at the bottom, you co-invest at the inception of the purchase transaction, this is a permissible transaction. And again, we can help you with that type of a transaction to make sure that it's structured properly and it is transacted properly so that that is can be done. So that is our LLC structure and how that might look in an SEC account. Here is the service that we offer. This is all that we do. We are only a self-directed retirement plan administrator. So we set up that retirement account LLC structure for your account. We have CPAs and attorneys available to answer technical questions. Our client services department gives you unlimited guidance on transaction compliance. You can call them, email them, as much as you need to regarding your transactions. We also handle all of the back office support that is necessary for a retirement plan. There are books and records that need to be maintained. We will maintain financial statements for your LLC. We will supervise the regulatory reporting, and we will oversee the annual valuation that must be done each year and sent to the IRS. So we are a full service retirement plan administrator. So now I'll ask you, how can we help you? Perhaps you know that you'd like to start self-directing some retirement funds, so we can help you get started with that and help you open an account. You might have clients in your own business or colleagues who would be interested in self-direction, or you may simply need more information. If any of that is the case, you are welcome to visit our website for more information. There are also there's client information out there. People talk about what they've done and how we have helped them. Our corporate number is there for you, and you can get in touch with me directly at the email address there. So please do get in touch. We would love to be of service and help you in self-directing your retirement account. Now I am going to take just a moment and open the floor for questions, and I'm going to look and see if I have received any questions while I was discussing. And it looks like I do have a couple. One is, how long does it take to get set up with STC? We do ask for 4 to 6 weeks for the complete setup process. We do, there are a couple of things we can't control. We can't control the time that it takes from your current custodian to move the money to our custodian. We can give you the information that you need, but they will not work with us directly. So we can't control that, but we'll help you communicate with them how you need to. We also can't control the speed of the setup of the LLC. We will stay on top of all these things, and while your account is being set up, we will keep you updated as to where we are in the process with emails. Once that funding of your account is complete, then you'll get a confirmation email. You're also going to get a binder in the mail that it has copies of all of your account documents and instructions on how to make future contributions and how to fund transactions. And once your setup is complete, then we can do same day or next business day funding of your transactions. So we can do that pretty quickly. Oh, and that was the next question. What Once my account setup is complete, what does STC require from me and what's the turnaround time? Okay, we have a form. It's called a request to transfer funds form. And that's a form that you complete with any supporting documents that tell us what you're purchasing, who you're purchasing it from, what's the cost, where to send the money, all those details. And we simply need one of those forms and the appropriate backup. And as long as all that paperwork is in order, we can have it funded by the bank the same day. We do have a 2 p.m. bank cutoff. So after 2 p.m. Eastern time, then it would be next business day. So we can same day or next business day fund that transaction for you. Okay. I want to start investing in real estate, but don't have enough in my IRA to buy a property outright. Do I have any other options? So yes, of course, I mentioned them during the webinar. You could get a non-recourse loan. That's a possibility. You could also partner with other funding sources, like in our example where you partnered with your father, your daughter, and some of your personal money. And another opportunity, it's not quite the same as owning a piece of real estate, but it's somewhat similar. You could actually loan funds to a real estate investor for a particular property and put a lien on the property as collateral for that loan. So if the loan wasn't repaid, you could foreclose. So those are just some things, ways you might be able to do that. Okay, I have time for 2 more questions. If you have a rental property in your account, who does the renter send their rent check to? Well, that really depends on if you are using a property manager or not. And we do recommend using a property manager so that you can maintain an arm's length distance between you personally and your retirement account so that you don't violate any of the prohibited transaction rules. So when a property manager is in use, then they'll collect the rent. The checks are made payable to them, and then they take their fee out, and then they forward the excess funds written payable to your IRA LLC. They forward them to us, and we deposit those into your account. Now, if you're not using a property manager, then the checks need to be made payable to your retirement account, never to you personally, and mailed to our office or to you, but you would just have to turn around and mail them to us if they send it to you. So they can make the payment, the rent payment payable to your IRA LLC name, whatever that is, and send it directly to our office, and we will deposit that. And as soon as we do that, we'll send you an email that we have received the money and it's been posted to your account. Okay, and one last question. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. We have clients who might have, for example, had a real estate investment and they sold it. And so now they have lots of proceeds in their retirement account and they have not found their next investment yet. So rather than just leave it earning at an escrow interest rate, they want to invest in something, and then when they're ready for their next investment, they can liquidate. So yes, you can open a brokerage account with any company that you choose. The account does have to be set up as a business account in the name of your IRA LLC, because that's who the investment is through. It's not you personally. And we do ask that you send us, our corporate office, copies of your monthly statements, because we do need to ensure that you haven't made any deposits directly into that account or taken any withdrawals directly out of that account. It all has to run through your retirement account at STC, but you certainly can do that. So let's say you did that, you set that account up, you directed us to put money into that brokerage account. We did that. Then you went in and you managed that money. You invested it in whatever you wished while you were looking for your next investment in your retirement account. Let's say now you found another real estate property you want to invest in. So now you go into that managed brokerage account and you liquidate whatever you wish to fund this new real estate purchase. You liquidate that within the account. We get notice that you tell us that you've liquidated, you send us a statement or documents, and then you tell us what to invest those funds in, what real estate. So that's how that can work for you. Please do let us know if we can be of service. Visit our website for more information. You can call our corporate office or get in touch with me directly. Thank you so much for joining me this evening. I appreciate it, and I hope we'll hear from you. Have a good evening.